Do you enjoy giving the state and federal government half of your income? Imagine working all year, earning $600,000 and then sending almost $300,000 of it to the state and federal government. Imagine there is a completely legal strategy that could redirect a portion of that money into owning income-producing real estate instead. Today, I want to show you how that works. It's based on a rule in the tax code called real estate professional status. And when it's structured correctly, it can significantly reduce the taxes paid by a high-income household. Let's start with a situation I see all the time. One spouse earns a very high income, and let's say for the example, it's $600,000. At that level, between federal taxes and state taxes, they could pay easily $300,000 a year in income taxes. Nearly half of their income is going to taxes. To understand how this strategy works, we first need to understand how the tax code categorizes income. The IRS generally groups income into three categories. The first one is earned income. That's things like W-2 wages, 1099 income, and other income you earn from working or operating a business. The second form of income is what they call passive income. This typically includes rental real estate and other investments where you're not materially involved. And then the third type of income is portfolio income. That's things like interest and dividends, capital gains. And here's the important rule. Losses from one type of income generally only offset income within the same category. Passive losses offset passive income. Portfolio losses offset portfolio income. But passive losses cannot offset earned income. So here's where the strategy comes in. If you or your spouse qualifies as a real estate professional, which is a designation on your tax return, the IRS allows you to buy rental properties and use bonus depreciation, which creates paper losses against earned income. So let me give you an example. Suppose a couple buys a rental property worth $1 million. They put 25% down, which would be $250,000. Because of the way the tax rules work with depreciation and bonus depreciation, that property could generate a paper loss of around $250,000 in the first year. Now remember, our example household was earning $600,000 per year. That $250,000 loss would reduce their taxable income from $600,000 down to roughly $350,000. That's how the strategy works. Now let's talk about how someone qualifies as a real estate professional. First, it's important to understand something. You don't have to be a real estate agent to qualify. Being a real estate agent could qualify you, but it's not required. The designation simply means that one spouse spends the majority of their working time involved in real estate activities. There are three main requirements. First, you must spend more than 750 hours per year in real estate activities. Second, you must spend more time in real estate activities than in any other job or business. And then third, you must be materially involved in the activities and keep proper documentation of all of this. It must be legitimate and it must be documented. When those requirements are met, those rental activities can be treated differently. Instead of being classified as passive losses, they can be treated as active losses. And when that happens, those real estate losses can be used to offset earned income, W-2 wages, 1099 income, business income. So let's revisit our example. This couple earns $600,000 a year, primarily from one person. The other person becomes a real estate professional. They purchase a property worth $1 million. They put $250,000 down. Through bonus depreciation, then they generate a $250,000 paper loss, which can now be applied towards earned income in the first year. That loss reduces their income from $600,000 down to roughly $350,000. At a combined tax rate of around 43%, that could reduce their tax bill by over $100,000. They didn't eliminate taxes, but instead of sending that entire amount to the IRS, they used their money to acquire an income-producing asset. And the tax rules help them recover a meaningful portion of that investment. There are three important guardrails here. The strategy must be legitimate and documented. The spouse claiming real estate professional status must truly meet the time requirements. And these strategies should always be implemented with the guidance of a qualified tax professional. But for high-income households, this can be a powerful planning strategy. It's not about avoiding taxes, it's about structuring investments intelligently within the rules that already exist in our tax code. Planning beats reacting, and sometimes the best strategy is simply owning the right assets in the right structure. If you're paying hundreds of thousands of dollars in taxes every year, would you rather send that money to the state and federal government or use it to build a portfolio of income-producing real estate? Because the tax code already tells us which one it prefers.